And September 15th came. That's the last trading day of the September contract. In fact, since volume kind of dries up a few days before the last trading date, you should do it a little bit earlier. You need to actually roll these things to the next contract. Since most volume is in the near contract, I'm going to roll them into October contract. Why? Because on September 12th or so, which is going to be the Friday before the last day of trading, uh, volume is going to dry up on the September contract, and October contract is going to kind of boom. If you look at the charts of these things, where is it? These are, volumes, I think. Let's look at this daily. Or 4 hours. Now let's do daily. Let me see. Okay. You see almost no volume before August of 25. Okay. If you could check when the August contract had expired. Third Wednesday, basically 11th of August. And there is almost no volume before 4th of August. I mean, remember, this is the graph of the September contract. So about a week before the new contract comes in, or the existing contract is going to expire, most of the volume switches to the next month. So on September 8th, I need to roll it over. So on September 8th, I'm going to go to the market and say, okay, whatever the market price is, I'm going to close my 160 long position on the September contract by taking 160 short positions. That closes the September position. And immediately I'm going to do 160 October position. And exchanges actually allow these rollover transactions happen immediately. Less transaction costs on those and bid offer spreads. So after that point, my position is going to be in the October contract. Until something changes in my natural position, I'm just going to keep doing that. Suppose my first liability is on October 5th. Okay. And on October 5th, let's say I'm supposed to pay 5 million euros. Of course, I'm going to make my payment, but my natural position size is no longer 20 million euros short. It's now 15 million euros short. So instead of needing 160 contracts, now I'm going to need only 120 contracts, which means on that day, I'm going to close 40 contracts of my position that day, and I'm going to go with that. That's how you manage a foreign exchange exposure using futures contracts. As I said, if you have the dates of, in fact, we may do something like that if any of you guys are interested in stuff in the future. We can develop a template where you can enter your obligations and or expectations of foreign currency on certain dates, and it's going to tell you on exactly on what day what you should do. So a computer can actually run that position for you. In the old days, we put junior traders on these things, and we told them, okay, you know our thingies. So on each of those days, basically call the broker. In the old days, you couldn't simply go to your computer and enter the order. You called your broker and you gave them an order to do certain stuff, and they sent that order to the exchange and it got executed. But nowadays, these futures contracts are actually 24-hour markets. Once the CME closes, something called Globex starts, which is short for Global Exchange. It's basically electronic trading. The CME itself, I mean, you can trade electronically, but it is actually a physical market. If you ever go to Chicago and you want to see mayhem, visit the board of CME, Futures Pit, as it is called, especially on days of high volatility, as today was. It's a zoo. You know, people make trades by using hand signals and stuff. And if you thought the New York Stock Exchange floor was interesting, it's nothing compared to a futures pit. If you ever want to see something like that on a movie, it was actually filmed using actual trading pits. You guys ever seen Eddie Murphy movie called Trading Places? It was back in 1980s. There are these orange juice futures traders, and these guys are brothers, and they make a bet. He says, "What if we found somebody from the street and we traded places with him? How is this guy gonna do in our, futures business and so on and so forth?" Let me see if it's available on Amazon or anywhere. Okay, let me close this. You can get it free at Pluto TV, Roku Channel, stuff like that. With Eddie Murphy being there, it's funny. Now, one, as we kind of talked about it last time, using futures markets to manage long-term positions is never the ideal solution. Uh, the reason is most of the volume is in the near contract. So you're not necessarily, let's say my exposure doesn't start until 2 years from now. The difference between the spot and futures is much higher if the interest rate differentials are higher in a 2-year maturity compared to right now. So you immediately create basis risk for yourself. Basis risk is the difference between the futures price and the ideal hedging instrument. The ideal hedging instrument here is a 2-year forward contract. But you're doing this by basically the 1 month forward contracts and keep rolling them over. Since interest rate differential, you're basically also taking interest rate risk, which when we do this thing professionally, we also manage that. But just by itself, it's risky. Two, as you have seen, running a hedge using futures contract has cash flow consequences. You may have to put up a lot of margin. I mean, I'm short euros in my natural position. So if euro goes down from 116 to 1, that's going to make me $20 million, right? In my natural position. But that's going to happen sometime in the future. But in the meantime, my hedging position is short, long. That means I have to fund that account to keep the position. So I'm going to have to come up with $20 million cash, which means I have to pay funding costs on that. Then 2 years from now, I'll get my money, or I'm going to have to pay less. But when that amount is high, you may have cash flow problems, just like it happened to Deutsche Metallgesellschaft. Economically speaking, these guys were completely hedged. So why is the company that's hedged in crude oil would go bankrupt? Because their futures position kept losing money, and they had to fund that. At some point, people tell you, how do I know that people on your natural position are going to honor their obligations? So they stop taking your risk, boom, you're gone.